Okay, so let's first talk about the criteria for categorizing leases. Now, when we're talking about the lessee, we have two different types of leases. We have operating leases and we have finance leases. Now, the lessee, this is the party that's actually using the asset. So for example, if you leased a car, right, you're the lessee, you're the person doing the leasing. In a bit, we'll talk about the lessor, and the lessor is the person who is actually providing the asset to be leased, right? But the lessee, for purposes of lessee accounting, we can only categorize leases as either operating or financing leases. Now, the criteria that we use to determine whether the lease should be an operating lease or a finance lease is as follows. We use the mnemonic bones. Now, if any one of these criteria are met, then the lease will be classified as a finance lease. So if the B is met or satisfied, then it would be considered a finance lease. If the B and the N are satisfied, then it's still a finance lease. Only one of these needs to be satisfied for the lease to be classified as a financing lease. If none of them are met, however, then it's considered to be an operating lease. So let's kind of talk through these. So the first one, the B, is a bargain purchase option. So this is essentially an option that can be exercised at the end of the life of the lease that lets you purchase the leased asset for really, really cheap. Now, a purchase option by itself is not sufficient to satisfy this criteria. I believe the criteria, let's see, it's somewhere in this document. There's like specific wording. I believe it's reasonably certain. That's the language that the codification uses for bargain purchase options. Essentially, there needs to be reasonable certainty that the lessee will exercise it. Otherwise, it's not considered to be like a bargain purchase option. And that's important because when we determine the present value of a lease, we take all of the future lease payments and we discount them back to the present. And that is the amount at which we record the lease. And for bargain purchase options, we would actually include those in the present value of the lease payments, right? If there's a bargain purchase option and it's reasonably expected to be exercised, then we would include that because it's basically like another lease payment that will be made at the end of the life of the lease to purchase the asset. And so we would include that in the present value for purposes of determining what to record the lease as, the amount, right? So yeah, with a bargain purchase option, it'll be very clear whether it's in fact like a bargain. In the questions, they'll either tell you it's a bargain purchase option or it'll be very, very clear. So an example of a question where they wouldn't tell you it's a bargain purchase option, but it's clear, would be if the fair market value of the leased asset was $1,000, but they were willing to sell it to you for $400. That's not like a mere discount. You're getting a steal on the asset, right? So if they don't provide you with information suggesting or telling you that it's a bargain purchase option, then you really kind of just need to look at the amount required to purchase the asset relative to the fair market value. And if it's like a crazy discount, it'll be a bargain purchase option, and it will always be like extreme. They're not going to give you a problem where it's like, oh, I'll sell it to you for $600 and the fair market value is $1,000, because that's kind of like gray area. It'll be very obvious, like in this particular example, right? The asset has a fair market value of $1,000. they'll sell it to us for like literally 60% off. Another example would be if the asset was worth like $2,000, but they were willing to sell it to us for $200. Right. It's such a discount that the person leasing the asset would have a very difficult time passing it up. That's essentially a bargain purchase option. So if a bargain purchase option is present within the lease, then we would classify that lease as a finance lease. Now the O is transfership of ownership. If at the end of the lease, the asset transfers from the lessor to the lessee, then this criteria has been satisfied. So essentially, at the end of the life of the lease, if the asset becomes yours, that's what this criteria is talking about. The N is NPV of lease payments. NPV is net present value. So if we take all of the lease payments plus guaranteed residual value and discount that back to the present, and that's greater than 90% of fair market value, then we've satisfied this criteria. Now, a couple important things with this item. The 90%, you need to know that. The 90% is pretty heavily tested. They're generally not going to provide that to you. So remember, 90%, I would say the N is for 90, right? 90 starts with an N. So, maybe that'll help you remember that for the N criteria, we use 90%. Additionally, so guaranteed residual value, the way this works is sometimes the person who is leasing you the asset, sometimes they will require that the value of the asset be a certain amount. For example, you lease a forklift and the person who is leasing it to you says, okay, at the end of the lease, the forklift needs to have a value of $1,000. Guaranteed residual value essentially means you are guaranteeing that the value of the asset will be $1,000 at the end of the lease. In other words, if you ding up the forklift and you use it a ton and the value's less than $1,000, you have to pay the difference. Essentially, you're guaranteeing that the value they'll get back is $1,000. Now, you can either guarantee it or a third party can guarantee it. Now, if you are guaranteeing the residual value, then we would want to include that in the present value of lease payments. Because essentially, you're committing to paying another potential lease payment if the value for whatever reason is below the residual amount that you've guaranteed. Now, if a third party guarantees the residual value, then we don't want to add that in because that has no ramifications for the lessee. So let's say we enter into a lease with the lessor and the lessor wants the value of the asset to be $1,000 at the end of the lease, but instead of requiring us to guarantee that amount, a third party steps in and says, okay, or we involve a third party and the third party says, I'll step in and I'll guarantee that the value will be $1,000 at the end of the lease. From the perspective of the lessee, we're not on the hook for any of that residual value, so we don't need to include that in the present value of the lease payments. So to summarize, for the present value of lease payments, we want to include residual value that's guaranteed by the lessee, not by third parties. And if the present value of all of our lease payments plus the guaranteed residual value is greater than 90%, then we've satisfied the criteria for the NPV. The next one is E, and this is another criteria that you're going to want to know the threshold for. The 75% is very important to know. They're not going to provide that to you. You just need to know it. And if the term of the lease is greater than 75% of the life of the asset, then this criteria has been satisfied. So we're essentially comparing how long the lease is to how long the asset can be used for. And if it's greater than 75%, then this criteria has been met. And then the final one is S, specialized. If the asset is so specialized that it has no alternative use to any other party, then this criteria has been met. So if we're leasing like a very specific machine that was developed just for our business, and the lessor would have no alternative use, they can't lease it to anybody else, they can't sell it, then that criteria has been satisfied. Now, essentially what all of these criteria are getting at is when any of these are satisfied, we have a finance lease. And finance leases feel like purchases. A finance lease feels a lot like we borrowed money and then purchased the asset, right? Or if we had just purchased the asset on account. You'll see with finance leases, we end up paying interest. It feels very similar to a long-term asset purchase using debt. And that makes a lot of sense when you look at these criteria individually, right? If there's a bargain purchase option, then the person leasing the asset is more than likely going to exercise that, right? If they can buy the asset for a steal, they will, which ultimately results in them owning the asset, right? So that feels a lot like a purchase. They're kind of making payments for it over time, and then it becomes theirs at the very end. Ownership, if ownership transfers, that's basically a purchase. If you're paying more than 90% of the fair market value, once again, you're essentially just purchasing the asset outright, but you're doing it over a period of time. And if you're using the asset for more than 75% of the economic life, you're basically using the asset for all of its, potential life, right? Which once again feels kind of like a purchase. You bought something and then you're now using it, until it doesn't work anymore. And then if the asset is really specialized, that also feels like a purchase, right? If there's no alternative use, if nobody else can use that asset but you, then what is the lessor going to do? Are they just going to let it sit around and do nothing, right? So if it's really, really specialized, and it doesn't make sense for anyone else to have that asset, feels like ownership, right? And that's what all of these criteria are getting at, right? They represent a finance lease, which feels more like a long-term purchase. Operating leases, on the other hand, feel like you're renting the asset. So you'll see in the accounting for operating leases, it feels like you're renting the asset as opposed to outright buying the asset. Okay. So let's now move away from the Bones criteria, and we're going to move into interest rates. So I mentioned before, when we calculate the amount of the lease, we go off of the present value. So we essentially discount all of the payments to the present value, and that will tell us the lease liability. That's essentially like the total lease amount that we owe, and then we make payments on it over time, just like we would with a loan. Now, there's a couple different interest rates that we need to consider for purposes of leases. The first one is known as the implicit rate, and the second one is known as the incremental borrowing rate. So your first choice should always be the implicit rate. And this is the rate that's implied in the terms of the lease. However, the lessee is not always aware of this rate. So the general rule is you always want to use the implicit rate for purposes of discounting to the present value, unless in the problem they tell you that the lessee is not aware of what this rate is. If the lessee doesn't know what the implicit rate is, then we need to go off of the incremental borrowing rate. But you have to be told that information. If they don't mention anything about the lessee not knowing the rate, use it. That should always be your first choice. Now, if in the problem they tell you the lessee doesn't know what the implicit rate is, then use the incremental borrowing rate. The incremental borrowing rate is essentially it's rates on similar leases that could be obtained in the marketplace. So if the lessee doesn't know what the rate is on their lease specifically, they can go look at other, leases and determine, what they think the rate will be. Now, for purposes of the lessor, we always use the implicit rate because the lessor always knows what that rate is. So we really only have to decide for the lessee whether we should use the implicit rate or the incremental borrowing rate. For the lessor, we only ever want to use the implicit rate. If they try and include the incremental borrowing rate as a potential answer in a lessor-related problem, they're trying to trick you because the lessor knows the implicit rate and that's what they're going to go off of. Okay, so let's start by looking at examples of operating leases, and then we'll take a look at financing leases. Now, I talked about this a little bit with bonds. Oh, looks like we might have a question. Can you repeat that for me? What part? The part about operating leases and financing leases, like the order will go in, or? Or were you asking about the rates? Oh, okay, yeah. So for the lessee, we have to decide between the implicit rate and the incremental borrowing rate, right? If we are not given any information that suggests that the lessee does not know what the implicit rate is, that's what we use. So on your notes, I would put first choice, implicit rate for the lessee. In the problem though, if they tell you the lessee doesn't know what the rate is, then you use the incremental borrowing rate. So that's your second choice. For purposes of the lessor, there's never a choice. It's always the implicit rate. If they tried to get you to pick the incremental borrowing rate, they're really just trying to trick you, because the lessor knows the rate on the lease. That's why we always want to pick the implicit rate when we're talking about the lessor. Does that make sense? Okay, so going back to this operating lease example, when we talked about bonds, we talked a lot about the present value factors. Same thing is happening here, right? You're not going to have to use a present value calculator like time value money calculator. You don't need to use specific functions in Excel. All you need to do is be able to identify the correct present value factor to pick. That's all you need to do. So kind of just to give you a refresher, remember annuities are for recurring payments. It's not an indefinite amount of payments, but it's recurring payments, right? If the payments are going on forever, that's what we would call a perpetuity. If the payments are recurring for a period of time, but are not indefinite, that's known as an annuity. And if the payment is a one-time thing, then that's what we would call like a lump sum. So with ordinary annuities, we're having recurring payments over a period of time, but they take place at the end of the period. So maybe every year for 5 years, we have a payment of $20,000 and it's coming at the end of the year. That's an ordinary annuity because the payments are being made at the end of each period. Annuity dues are recurring payments once again, but the payment comes at the beginning of the period instead of the end. Now, it's very important that you pay attention to the timing of payments, especially for leases. With bonds, it's not very common to see interest payments at the beginning of a period because interest is typically paid once it's been accrued, right? So it doesn't make sense to make a payment before any time has passed. Leases is a completely different story. With leases, they love to test annuity dues. So always make sure you pay attention to when the payment is happening, right? Beginning of period equals annuity due, end of period equals ordinary annuity. So you need to be able to distinguish between the two types of annuities, but you also need to make sure you pick the correct interest rate because it's likely that they will give you present value factors for both the implicit rate and the incremental borrowing rate, right? So they're going to give you more present value factors than you need, which means you need to be able to pick the right ones, right? So remember, for the lessee, we always pick the implicit rate. So we go with the present value factor that uses the implicit rate unless we are told that they don't know what this rate is. If we are told that they don't know what the implicit rate is, then we want to pick the present value factor based off of the incremental borrowing rate. Now, for the lessor, we always use the implicit rate, right? So that same rule is true for purposes of picking the correct present value factor. So to summarize, you need to be able to pick the correct factor based off of whether it's an ordinary annuity or an annuity due, and you need to be able to pick the correct one based off of the interest rate that should be used. Now, for this question, so it's the lessee. We're leasing PP&E from Gustavo Autos for 5 years, and they tell us it's an operating lease. So generally, the first thing you'll do for a lease question is you want to figure out, is it operating or is it financing? And you run through the bones mnemonic. Is there a bargain purchase option? Does ownership transfer? Does the net present value of the payments exceed 90% of the fair market value of the asset? What about the economic life? Is it greater than 75%? Is the lease term greater than 75% of the economic life? And is it specialized? So you run through those criteria, you figure out, is it financing or operating? And then, right, based off of your evaluation, you come to a conclusion. And then at that point, the next step is to calculate the present value of the lease. That really kind of kicks off the amortization table we're going to put together. And you'll pick your present value factors based off of what we just talked about, and you'll use those to discount your payments to the present value. So it says here the lease has an implicit interest rate of 5% and no guaranteed residual value. Bare Bones Logistics made total annual lease payments of $12,000 starting at the end of year 1. Okay, so it's at the end of year 1, which means ordinary annuity. So we take the payment of $12,000 and we multiply this by the 4.3295. And that comes out to be, let's see, I'll punch that in my calculator, 51,954. So that is the present value of our lease payments, right? It's 5 lease payments taking place over 5 years at the end of each year. So the present value of our lease is 51,954. This was a particularly easy problem because they told us, you know, that it's an operating lease, and they didn't throw any information trying to trick us with the interest rate to use. So the first journal entry that we would make is we're going to debit ROU asset for 51,954, and we'll credit lease liability for 51,954. Now, this lease liability, this represents the total liability of the lease, right? With leases, They feel similar to debt. Finance leases more so because we have interest expense for finance leases, but even operating leases, it's still technically like debt, right? Because we're required to make payments over a period of time. So we're essentially recording a liability for the present value of our future obligations, which is why the liability. Now, with leases, we're really purchasing the right to use the asset. Now, finance leases, a little bit different, but let's talk specifically about operating leases. We're essentially renting the asset, right? We don't have the right, we're not purchasing the right to own the asset or anything like that. We're purchasing the right to use the asset. And so since we're focused on the right, that's more of an intangible thing, right? And so we record ROU asset, which is right of use asset. And that essentially captures the asset that we have or the future benefit associated with the right we have to direct the asset as we see fit. So that's the initial journal entry. Now we're going to set up a table like we did for bonds. So the first step is I'll put LL for lease liability. And then interest expense. I'll put principal. Then I'll put difference. So we're essentially going to plug in our beginning lease liability balance here. We're going to calculate interest expense, and then we'll have the principal, we'll take the difference, right? Just like we set up with debt. Now with bonds, it's a little bit more tricky because we have to manage two rates, right? Especially if there's like a discount or a premium. We have to manage the market rate and the coupon rate. For this, we're just using one rate, right? So in this case, we're told the implicit rate is 5%, so that's what we use. So we would take the 51,954 and multiply that by 5%, which is going to be $2,598. And once again, that's the 5% implicit rate times the lease liability amount of 51,954, right? We took the interest rate and multiplied it by the liability. Now, actually, I wanted this to be payment. That's what, yeah. Now the payment we're making is $12,000 every period. So what's the difference between these? Well, the difference then is going to be 9,402. And if we subtract this difference from the lease liability, we get to 42,552. Okay, now journal entry time. So with operating leases, we don't record interest expense. In fact, let me rewrite these in black so they don't stick out, because I really kind of wanted to just emphasize the interest expense here. We don't record any interest expense with operating leases. Instead, we record lease expense. So that's a defining feature of operating leases. With finance leases, we don't have lease expense. We have interest expense and amortization expense. But with operating leases, we just record lease expense every period. And the lease expense is going to be equal to the payment that we make. Now, if you look, the interest expense or the lease expense of $12,000 is comprised of two things. It's comprised of interest expense of $2,598 plus this difference. Now this difference, that's how we amortize. So because this is an intangible asset, right? It's the right to use the asset. Instead of depreciating the asset itself, we're amortizing a right to use the asset. Since we don't actually own the asset, we are not depreciating it. We're just amortizing the right we have to use the asset. So we're going to, first of all, reduce our lease liability by 9,402, which makes sense, right? If we make a payment of $12,000 and the interest that technically was incurred is $2,598, then that means only $9,402 of our payment will actually make it to the principal or the lease liability. So that's why we reduce lease liability by that amount. But then we're going to credit accumulated amortization. So essentially, this lease expense here is a combination of interest expense of $2,598 plus amortization expense of $9,402. But instead of breaking it out and debiting interest expense and amortization expense, we just roll it all up and expense it under the name lease expense. So lease expense is essentially a combination of both interest expense and amortization expense. We're just combining them and calling it something different. So the amount of lease expense it's going to be straight line. That's a feature of operating leases because the lease expense matches the payment that we make. The payment we make is going to be the same every single period, which means our lease expense will be the same every period. Now, as we pay off the liability, obviously our total liability balance will decrease, which means the interest expense calculation will go down. And so as the liability balance gets lower and lower, the interest expense will get lower and lower, which means the amortization portion of our lease expense will get higher and higher. Essentially, what we're doing with operating leases is with our lease expense is fixed, right? And we're assuming that part of that is interest expense, and then we're just plugging for the difference. The difference between our total lease expense for the year and our interest expense, we're assuming is just amortization expense. It's not really like important because we're not actually recording interest or amortization expense. But basically, the idea of what we're doing is by debiting lease expense, we're hitting that account for the amount of interest, and then we're plugging for our amortization expense. But you don't need to know, like they're not going to test you on the interest expense or the amortization expense. They're going to ask you specifically about lease expense. But I think it's helpful to understand that lease expense is really just a combination of interest and amortization, with amortization expense just being the plug, right? If you look over here, you see we start at 51,954. We have our payment, interest expense, right? We already did that first row. If you come down to the second row, we start with our ending lease liability balance. So we start year 2 with the year 1 ending balance. We have our lease payment of $12,000. Our interest expense is now lower. You see how it's $2,128 instead of $2,598? Well, that's because the interest is calculated based off of our lease liability. If our lease liability is lower, the interest will be lower. But remember, the lease expense is still the same, $12,000, which means the portion of lease expense that is coming from amortization is higher. right? And you can see the portion that's coming from amortization is $9,872. So the interest expense component of lease expense will get lower over time, and the amortization expense component will grow over time in order to keep lease expense fixed throughout the life of the operating lease. Any questions about operating leases? Essentially, you would just make these same journal entries for all of the years. So you really only need to know the initial journal entry where we record the asset and the liability. And then you just need to know this journal entry right here, right? These two journal entries we make, that's how we record the lease payments. Any questions about operating leases? Does that make sense to everyone? Yeah, I'll get to lessor in a little bit. I want to work through all the lessee first. All right, so let's move on to the and if you come back, like there's questions you can look at with numbers if you want, more examples. But let's now talk about finance leases. So finance leases, the biggest difference between an operating lease and a finance lease, and remember, this is for purposes of just the lessee still. With finance leases, instead of recording just lease expense, we record interest expense and amortization expense separately. So we're essentially just breaking those items out. That's really the biggest difference in terms of accounting. So if we went ahead, this is the exact same problem, so I don't want to walk through the present value factors or anything like that. Remember, we took the $12,000 payment, we multiplied by the ordinary annuity of 4.3925, and that gave us a present value of 51,954. So the initial journal entry is the exact same, right? We record ROU asset and lease liability. Nothing changes with that. The initial journal entry between operating and financial leases is the same. The only difference is when we record journal entries for the payments that we make. That's really where you see the differences. So if we set up a table, we've got lease liability of 51,954. We have a payment. We've got interest. We've got our difference, and then we've got lease liability. So our payment is still $12,000. The initial interest expense, we already did that. Remember, we took the 51,954 times the 5%, and that gave us 2,598. And the difference is 9,402. And then we reduce our lease liability by that amount, which would be 42,552. So the journal entry we would make here is we would debit interest expense for 2,598. And then we would debit lease liability for 9,402, and we would credit cash for 12,000. This feels very similar to how you would account for a loan, right? You make a payment on the loan. Part of that goes to interest. Part of that goes to principal. That's essentially what we're capturing in this journal entry. Now, the biggest difference is amortization is also calculated a little bit differently for purposes of financing leases, right? With an operating lease, the amortization was baked into our lease expense. And essentially we were just plugging for each period, right? But it was rolled up inside of lease expense. With financing leases, we actually do record amortization expense. And generally how we do that is straight line. We take the amount of the ROU asset, which is 51,954, right? If you remember the very first journal entry, we would have debited ROU asset. for 51,954, and then credited lease liability for 51,954. So we pull the ROU asset down here and the lease liability goes up here. Now, generally these numbers are the same, right? But sometimes the lease liability could be a little bit different. So I just want to show you that for amortization purposes, we're going off of the asset amount, whereas for liability purposes, right, we set up our table based off of the liability. Now, like I said, in 90% of, and I'm pretty sure in like every question you'll see, these two are always going to be the same values. But if for whatever reason they weren't, you don't want to use your lease liability for calculating amortization, because we amortize the asset, not the liability, and we calculate interest expense based off of the liability, not the asset. I don't think that's a huge problem, but I think it's worth pointing out, you know, just in case they get tricky. Okay. So we do it straight line, right? We take the $51,954 and we're going to be doing this over the life of the lease, right? So the lease is 5 years. So 51,954 divided by 10, or sorry, by 5. That's 10,391. So you just take the ROU asset, divide it by the terms of the number of years in the lease. That gives you the amortization. And then what you do is we're going to debit amortization expense for 10,391. And then we'll credit accumulated amortization for 10,391. Now, I do want to mention, let's see if we come down here. So when we look at the Bones criteria, remember, if any one of these is met, it's considered a finance lease. If the ownership criteria or the purchase option criteria is met, then we use the useful life of the asset. So when we calculate amortization, right, if there's a bargain purchase option or ownership transfers, then we would use the useful life of the asset in the denominator. So instead of amortizing over the life of the lease, we would amortize over the life of the asset. Now, they would not give you a problem where, you know, all of the Bones criteria are met and then you have to like figure this out, right? They would give you either like 1 or 2 that would have to fall in the same category. But if the B or the O criteria is met, then we use the useful life of the asset as our amortization criteria. And then if the N, the E, or the S is met, then we use the shorter of the life of the lease or the life of the asset. So we picked the shorter. It's straight line. Yep, you amortize the same amount every year, but if the B or the O criteria are met, then you're amortizing the same amount over the life of the asset. Whereas if the N, the E, or the S are met, then you are amortizing over the shorter of the life of the lease or the life of the asset. I don't know how likely that is to be tested, but it's important to point out nonetheless. See, I did not follow your explanation about ROU asset or lease liability, where you say we don't amortize the lease liability, but the asset. Okay, so essentially what I was saying here is when we make the journal entry, we debit ROU asset for 51,954 and we credit lease liability for 51,954. what I was pointing out is when we amortize based off of the ROU asset value. So if for whatever reason they gave you a problem where the lease liability does not equal the ROU asset, you want to make sure that you amortize based off of the ROU asset, right? Now, in this problem, the lease liability and the ROU asset equal the same thing. So it's not a problem. We can just use the 51,954. But if for whatever reason the liability doesn't equal the ROU asset, which I don't think they would do, but if they did, you would want to make sure that you grab the ROU asset number for purposes of amortization, and then make sure you grab the lease liability number for the table you put together, right? Because interest expense is calculated based off of the lease liability, not the ROU asset. So the ROU asset goes to amortization. The liability goes to the table where we determine interest expense and the principal payment. Does that make sense? Okay, so that's pretty much everything for the lessee. Biggest difference between operating and financing leases. Operating leases, everything is being rolled up into lease expense. With financing leases or finance leases, we break out amortization expense and interest expense, right? We record them separately. For purposes of amortization expense, it's always going to be straight line, but we need to pay attention to which of the 5 criteria are being met for purposes of determining the period of time over which we recognize the amortization. But let's go ahead and move on and talk briefly about the lessor here. And the lessor is pretty easy, honestly, for purposes of the CPA exam. I think most of the challenging questions you'll see will be for the lessee. So for the lessor, we have 3 types of leases. Remember, the lessee has 2. We have operating and financing. With lessor, we break out finance leases into 2 specific types, right? We have a sales type lease, which is one type of finance lease. And then we have a direct finance lease, which is another type of finance lease. So essentially, we're getting more specific with the type of finance lease. So we have an operating lease, and then we have 2 types of finance leases, sales type and direct finance leases. Now, a sales type lease feels a lot like a sale. In fact, we're actually going to recognize a gain. So imagine you sold an asset at a gain. That's how it feels with the sales type lease. That's essentially how we're treating it, right? We're going to recognize a gain for the amount of the lease above the value. We'll recognize interest, and then we'll reduce principal. Now, for the direct finance lease, that's like a pure debt agreement, right? Where essentially, imagine that we're just like borrowing money. That's kind of how it feels. Or sorry, that we're lending money, right? We're lending money. We would record interest income and then reduce principal. So instead of feeling like a sale, it feels more like a debt agreement where we're being paid interest, and then part of the payment reduces principal. And then an operating lease stays the same. It feels a lot like just a rental agreement. Now, for a sales type lease, to determine if the criteria have been met for this, we once again look at the Bones criteria. So if there's a bargain purchase option, if ownership transfers, if the net present value is greater than 90% of the fair market value, if the economic life is greater than 75%, and the asset is specialized, if one of those 5 is met, then we would classify it as a sales type lease. So the lessee, remember, if one of the criteria is met, they classify it as a finance lease. If one of the 5 is met for the lessor, they record it as a sales type lease. And for sales type lease, we treat the asset as if it were sold, since essentially that's like what we've done. right? From the lessee perspective, it feels like we're actually buying the asset. So from the lessor perspective, it feels like we're actually selling the asset. So in this example here, it says on January 1st, year one, Bare Bones Logistics leased a truck from Gustavo Autos that will require that Bare Bones makes 4 payments of $15,000 over the 4-year term with an implicit rate of 5% and an incremental borrowing rate of 7%. So this is, I think it's the same. Actually, maybe it was 12,000. I think it was 12,000 before. So similar problem, different numbers though. Assume that the present value of the lease payments amounted to $66,424. Now, really quick, if they asked us to calculate the present value of lease payments, we would do that using the implicit rate. Remember, the lessor always knows the implicit rate, and the implicit rate is the first choice. We only pick incremental borrowing rate if we are the lessee and we don't know the implicit rate. So we would have used the implicit rate of 5% to calculate the present value of $66,624. And the truck had a fair value of $66,424 and a net book value of $62,500. Assume the lease is classified as a sales type lease. So what we would first do is we would record a lease receivable. From the lessee perspective, we record a liability equal to the present value because that's essentially the present value of all of the payments we're going to have to make in the future. Well, from the perspective of the lessor, we're getting payments in the future, right? So if we discount all the payments we'll be getting, that's a lease receivable. This represents the present value of all the lease payments we'll be receiving in the future for or in exchange for the asset that we've essentially decided to lease to them. So we record lease receivable at the present value, and then we subtract the difference between the difference between that lease receivable, the present value, and the book value is a gain. So imagine we had sold the asset for $66,424, right? The journal entry we would have made is debit cash $66,424, credit asset $62,500, credit gain, right? The only difference is we're not debiting cash here. Instead, we're debiting a receivable because this will be paid out through multiple payments. So we record a gain for sales type leases as though we had sold the asset. And then what we'll do is record interest income. So if we take the lease receivable of $66,424 and multiply this by 5%, that comes out to be $3,321. Every time we get a payment, we're going to record cash of $15,000, right? And for this first payment, we're recording interest income of $3,321, which means we will then reduce our receivable for the difference. So if the first $3,321 of the payment is related to interest, then that means the remainder of the payment is pure principal. That will just reduce the receivable that we are owed. Will present value of lease payments always equal fair value of asset given up? I would say for the most part, especially for the lessor, it doesn't make sense to lease an asset at less than fair value unless you have like a related party thing going on. So if they don't provide any information to you suggesting that it's different, just assume that the present value is the fair value, right? And that's actually one way to calculate the fair value, right? By taking the present value of the future payments. So I would say for the exam, always assume those things are equal, and then just take the difference between that and the net book value, and that's your gain. But yeah, this is the journal entry you'll record, right? We'll record cash. Part of that's for interest, right? And then we'll reduce the receivable for the difference between the cash we received and the interest income that we recorded. So pretty straightforward. Any questions about sales type leases? Okay, let's go to direct finance leases now. Now for direct finance leases, we first start, so we have the bones criteria. If any one of these are met, then it's a sales type. If none of these are met, then we move on to, we check two other things. So what we check, the two additional criteria are net present value plus guaranteed residual value by third parties. And the second one is that the lease payments plus the guaranteed residual value equal like collectible. And both of these have to be met. So if none of the bones criteria are met, then we essentially check to see, okay, if you add in the guaranteed residual value of third parties and it's likely that it will actually be collectible, do you exceed the net present value test? So really, we're just focused on this one. So we start with the bones criteria. If any one of the bones criteria is met, it's a sales type lease. If none of them are met, then we take a step back and we say, okay, well, what if instead of just looking at lessee, guaranteed residual value, let's add in third party guaranteed residual value. Is it collectible and is it probable that we'll get that? If it is, let's add that into the net present value test, right? And then if that exceeds 90%, then we would call it a direct finance lease. Now, if you fail the net present value test again, meaning even with the third party guaranteed residual value, you still don't meet 90%, then it's an operating lease. So essentially we have one sub step in between sales type lease and operating lease, right? We start once again by looking at all the bones criteria. If any one of them is met, it's a sales type. If none of them are met, we take a closer look at the net present value test. We add in the guaranteed residual value by third parties. If that pushes the net present value above 90%, then we've met the test for purposes of direct financing and we will apply that method of accounting. Otherwise, we just classify as an operating lease. Now, the biggest difference here is we are not recording a gain, right? With a sales type lease, the difference between the present value / receivable and the net book value is a gain. Well, what we do here is we simply record a receivable for the present value of the asset, and then we credit the asset to remove it from our books. So we're still removing the asset from our books, but we're not recording a gain because we're not treating it like a sale. Instead, we're treating it like the asset is being financed over time, hence the direct financing lease. So we record a receivable in exchange for the asset, and then we record everything else the same. So really the only thing that's different is in the initial entry, we don't record a gain. And that's because we treat it as though it's being financed over a period of time, not sold. Sales type leases are treated like a sale. Now, operating leases are really, really easy. You'll have an operating lease when none of the bones criteria have been met and a direct finance lease has not been met, right? So none of the bones criteria have been met. You take a closer look at the NPV calculation for purposes of direct financing. It still fails. You then classify it as an operating lease. And with an operating lease, you recognize income on a straight line basis, right? So you don't remove the asset from your books. essentially all you'll do is you'll record lease income and then cash. So you would basically just debit cash like 12,000 and then either like rental income or lease income of 12,000. Really easy. It's probably like the easiest type of lease